The Indian markets open higher, shrugging global weakness after a one-day holiday as it catches up with Trump's 90-day pause of tariffs. The key indices are up close to around 2%. The market breadth in favor of the number of stocks advancing. Metals lead the gains on the back of a global relief rally and the lower dollar index. Additionally, Tata Steel has announced transformational proposal for its Netherlands unit. The stock is one of the top gainers on the Nifty. Cipla's up close to 3.5% as the company gets a US FDA approval for a breast cancer drug. Brokerage Elara Securities says the company has the potential to generate up to $50 million from this product. Other pharma companies climb. Sun Pharma is up 3% after the US court lifts the injunction on the launch of a hair loss drug. Biocon as well is up close to 3% after the company expands its oncology portfolio in the United States. Gold finances Muthoot Finance under pressure after the Reserve Bank of India releases the new draft rules on gold loans. The stock is down 5%. Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 News Studio. I'm Nigel, and in a short while from now, Mangalam will be joining in. Well, the markets are holding well in the green, so let's get a technical check. Manas Jaiswal joins in on the show. Hi, Manas. Good morning. Good to see you win. Well, the Nifty is very, very close to that resistance level of around 22,900, 22,950. What would you do at this juncture? Would you take some money off the table or would you ride your longs? Also, give us your view on the Nifty Bank because that's leading the way over the last few trading sessions.
Good morning, Nigel. So the positive point is both the indices, Nifty and Bank Nifty, have given confirmation of higher tops and higher bottoms on the intraday chart. So that is definitely positive. But I'm still cautious because in this range, 22,800 to 23,000, in this range, three important moving averages lie. 10-day, 20-day and 50-day moving average. So I would like to create long position aggressively only if Nifty breaks 23,000, not before that. I am still cautious. But yes, in many stocks, you can create long position where you see some sign of reversal. However, if I want to take a position in indices, I would prefer Bank Nifty because here Bank Nifty has broken 10-day moving average also. So here one can create long position, keep the stop loss below 50,600. And I think Bank Nifty can test 51,500.
All right. So that's your view on the Nifty and the Nifty Bank. Individual stocks, you did say that there are a couple of opportunities there. Manas, what are you looking at here?
Good morning, Mangalam. So two recommendations, both are large cap stocks. First is Bajaj Finserv, where stock has given a confirmation of higher tops and higher bottoms. It is trading above 10-day, 20-day moving average. So one can create long position in Bajaj Finserv. Stop loss should be around 1924. Target would be around 2020. Second is a buy on NTPC, where stock has regained 10 and 20-day moving average. It has given a fresh breakout on the intraday chart. So NTPC can be bought with a stop loss of 352. Target would be 365.
Okay, all right, Manas, thanks a lot for joining in, filling us in with your take on the Nifty as well as individual stock calls. Well, let's shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Sachin Pal of moneycontrol.com joins us to talk about a stock he's tracking. Sachin?
Yeah, thanks. The stock in focus is here Sensex, which is a leader in both the faucetware as well as the sanitaryware industry. Well, for the first 9 months of FY25, the company has reported a flat top line on a YOY basis, mainly on account of lackluster demand trends in the real estate market. Margins, on the other hand, have witnessed some contraction due to increase in raw material costs as well as dealer discounts on account of sluggish offtake across the retail channels. However, the company has undertaken some price hikes both across the faucetware business as well as the sanitary business, which should pave the way for margin recovery to almost 15 to 16% at the operating level in the next couple of quarters. Well, the overall demand trends in the real estate market continue to remain lackluster, and therefore the management has put the plan of capacity expansion in sanitaryware at hold for the time being. Well, overall, the demand trends remain lackluster, but the company has seen a strong correction of 50% in the stock price from its all-time highs and is currently trading at around 28 times FY26 estimated earnings, which we believe is very reasonable for accumulation from a long-term standpoint.
All right, with that, we'll slip into a short break. But just before we do that, just keep an eye out on a couple of these stocks. One from the pharmaceutical pack is Divi's Lab, a big mover, maybe participating in the relief rally that took place, after all the global markets have taken a, bit of a leg up on account of the pause that has come by on the tariffs. The second pack we're looking at is the real estate pack. So we have Prestige Estates, which moved higher. We have Oberoi Realty, which has moved higher. So maybe lower rates, a more accommodative RBI policy could be positive for the real estate space. We take a short break. On the other side, we speak with Ashish Rai, who's the global CEO of Orient Pro Solutions, to discuss their business outlook and a lot more. Stay with us. Welcome back. You're watching us here on Chartbusters on CNBC-TV18. IT is the sector of the day. There's a bunch of news that is, focusing around IT. One side you have TCS, the management commentary along with the results. On the other, you have the prospect of slightly better than feared macroeconomic situation on account of the 90-day pause in tariffs. Orient Pro Solutions is one of those stocks on our radar, down about 15% year to date. We're speaking with the management of TCS earlier. They did highlight that there was some impact in the fourth quarter due to macro uncertainty. Is this a broader view for the IT sector itself or not? To discuss this and more, we have with us Ashish Rai, who's the global CEO of Orient Pro Solutions, joining in. Ashish, thank you so much for joining in. Good morning. And that really is the first question. There is macro uncertainty. TCS did say that certain projects which were expected to start haven't because of delay in decision making. So the question is for you, how was the fourth quarter? Are you on track for that 40% growth guidance that you had earlier given? And are you witnessing delays in orders?
Yeah, hi, good morning. First of all, thanks for having me. I would not comment so much about the IT services play. We are a very focused products and platform vendor that operates across the globe. I think for us, the demand environment, I don't think there is any change. We have, I think we've grown at about 34-35% now for 4 years. So there is a strong trajectory of growth. Demand environment remains reasonably strong. I would not specifically comment on Q4 because we will, when we come out with the results, our guidance has been that we'll grow between 30 and 35%, and we'll declare the results. Then we'll come to you with more specifics. But for the last 4 years, we've grown at 34-35%, and I think that the demand environment remains pretty good. Now, to the extent that and US is less than 10% of our revenue, so it's not really a big market for us. I think that will sort of do what it do. If the entire world goes into a slowdown or something, then I suppose it affects everyone else. But for now, we don't really see much change in terms of demand.
Hi, Ashish. Good morning. Good to see you in. This is Nigel on this side. US is a smaller market for you, but in the past, you've said that, say, in the next 4 to 6 quarters, you expected to get to around mid-single digits. Is that plan still on? Say around 5% of your mix should be coming in from the US?
Yeah, Nigel. So in the products business, it does stay enterprise software business. It takes time to grow into the mature markets. I think US is coming up to double digits now for us in this year. And we made a very significant bet on Europe over the last 6 months, and over the next 4-6 quarters, we expect even that to get to double digits. So I think by and large, over the next, I would say 6 to 8 quarters, we would expect US to stay in double digits, Europe to stay in double digits, and Asia by and large to get to, let's say, between 75 and 80%, right? That's the mix we are going for. It takes time for us to grow in those markets, but I think by and large now we are getting there in terms of the initial references, in terms of the sort of traction in the market.
And what about the next year? You said that obviously you can't speak a lot about the fourth quarter because of regulatory issues. You're in silent period when it comes to that. But, we see close to around 1,300 crores in terms of your order book right now. If you could, update that for us. And what does that set you up for growth in the next year? Are we looking at 30-35% in FY26 as well? Or could you do a clip better?
Yeah, so look, we will come back with guidance when at the end of the year we'll look at it. But by and large, I think you pointed out the right thing. The order book is in a very strong position right now. And typically the next 4 quarters revenue, more or less, order book is sort of the single biggest factor. So that is in shape. Growth trajectory has not meaningfully changed for us for 4 years. I think by and large, it will stick around the same thing. We are very, I think we are in multiple segments, each of them, whether it's lending transformation, whether it's transaction banking transformation, whether it's payments, whether it's data center. We have built out some of the most competitive product stack in the world. We have exceptionally strong win rates. So to the extent that there is demand in the market, I think we'll continue to take share. For us, demand really has not been a problem last 4 years. It's really been how can you grow cautiously in a way that we keep the delivery reputation intact, we take our clients successful. Products business are complex because you have several moving parts, so you need to grow at a sort of steady rate rather than try to really grow very fast. For us, that right level has been about 30-odd%, and I think we will continue to try to do that. So demand, really has not really been a factor in growth. It's more how much do you want to grow, how much can you scale capacity, how much can you scale execution to service the demand. And for us, roughly the last 4 years, what's worked out for us is a number around 30-odd%.
Ashish, what the street took heart from the fact is that, before you took over at the helm, you already had a good stake in the company. It always helps when the person who's heading the company has around 7-8% stake. Now, my question to you is, brokerage is pointing out in the last 3 years, revenues have doubled from the time you have taken over. Do you think with the visibility that you'll run an SBI contract, you had that Panvel contract as well, all those will start flowing through. In the next 3 years, do you think you can do more than 2,000 crores of revenues? This year, you should end in the vicinity of around 1,200 crores. And would that mean that profitability as well, the PAT number for 2028 will be closer to that 380 to around 400 crores? Is that doable? Revenues of more than 2,000 crores and profitability around that 380, 400 crores?
Yeah, so Nigel, good question. We don't give out forward guidances that far out. This is what I'll say, right? We have, when we started our pivot 3.5, 4 years back, FY21, we did 375 crores. This year, our guidance is to do between 1150 and 1200 crores, right? We'll see where we land up. We have a stated Vision 2030, where we have sort of the external articulation is qualitative. Obviously, we got an internal articulation of Vision 2030, which is quantitative targets and all that stuff. So we have numbers going from now till 2030. We've so far tracked ahead of it. The stated ambition is to be a top 3 global player in each of our chosen spaces. So for us, really the focus is get to product superiority, get to the best product in the market, and scale.
But Ashish, qualitative outlook, which is external, everyone knows. Quantitative, which is internal, we just want to know a range. What is it that you're thinking? From now to 2030, do we see revenues doubling from what they have already? Is that a possibility, or will it be a little more than that?
Look, if we keep going at 30% from now till 2030, it would be probably 3 or 4 times, right? So
exactly.
And an Excel sheet exercise would take you there, right? We don't intend to slow down. Right? We will not publish a number 5 years out, but we don't intend to slow down. So roughly, I think we will try to keep the growth trajectory we've been on. The difference in the statement, I would say there is this, right? Each of the spaces we are in are double-digit billion-dollar spaces, right? So if you are a top 3 global player in those spaces, you are a very, very large player. You would probably not get there by growing at 30% from now till 2030, right? So for at least some of the products between now and 2030, I would expect we hit some sort of an inflection point where you hit an hockey stick, right?
Yeah.
But it would differ product by product, right? But by and large, I would say we intend to keep the growth trajectory going.
You don't give us a number. You don't give us a number. Let's let us, give a headline number. 2030, 5,000 crore on the top line. Is that achievable?
Look, if you are a top 3 global player in the spaces we are in, why not?
Okay, interesting. Why not? And margins will continue to be your target is to stay in this 20-22% margins. Is there a downside risk over there, or is there an upside risk?
So, Nigel, I think in the product business, what really happens is as you scale, the economics improves.
Okay.
So typically in a steady state, if the growth rate comes down, I would expect the margins to go up. But the slight catch there is we very clearly guided for the next 2-3 years, we do not expect to improve the margins because the way we operate is we are product builders. We invest a lot in R&D. this year we'll invest almost 9.5% of the top line into R&D. Next year it will go up. So, and we expense all of this R&D, right? So the way we will operate is, as the economics improves, at least for the next 2-3 years, we will pour the excess back into R&D, build more products out for Europe, for US as we're expanding. After 2-3 years, we will see what we want to do on the EBITDA side, right? Till that time, we will not try to max out the EBITDAs.
Okay. All right. Very quickly, you'll have done some inorganic growth in the last few years. What is the current cash in the books? Is there more in store?
So I think the cash levels are healthy. We are obviously zero debt. Again, we'll publish out the number when we publish the balance sheet in a few weeks. But I think the way we are looking at it is, all our R&D by and large is expensed out. So whatever cash we generate after that is available for M&A, which we will use for inorganic acquisitions as we go, right? Because most of the organic investment is already taken care of in the P&L, right? So that's how we operate.
And just a follow up on that. When you give us your 2030 target, assuming you do X billion dollars or closer to that sometime around that itself, what would the revenue mix of the company be? How much would be organic? How much of that would be inorganic? Fenixys, how much would that contribute to your overall pie?
So Fenixys is a key piece for us in Europe, but it is a means for us to scale all the other product lines in Europe as well, right? So I think we don't really acquire for revenue. We acquire for IP, and we acquire for the quality of the team, and then we grow the rest of the business organically, right? So I think inorganic, from the standpoint of what will it be as a percentage, I think it will always more or less stay single digits unless we find some opportunity to really acquire meaningful. But we typically acquire for the quality of IP rather than for revenue, right? Revenue, I think we know how to grow, and it's more a question of where do you have gap in the strategic blueprint for a particular area, and then we fill that gap with a piece of IP.
All right, Mr. Rai, always good speaking to you. Thanks a lot for joining in on the show. We're going to hold you to these numbers, and hopefully the end of Q4, we can squeeze you a little bit more to get the near-term outlook. But as you said, by 2030, you're seeing a big runway in terms of revenues, and you're protected for now because you don't have that much exposure to the United States. Well, time to slip into a short break. On the other side, we'll continue to focus on markets. Don't go anywhere. Welcome back. Markets still holding with a 400-point gain. I'll tell you what, the Nifty Bank actually is doing a relative underperformance, and that's facing some resistance at the 51,000 odd mark, which is the crucial 200 DMA. So that's the mark you need to track. For the time being, we come off a little bit from the top. But Vinny joins us. She's tracking a few companies, and she's joining in here on Chartbusters. Vinny, tell us.
Hi, good morning, Nigel. So what I'm keeping an eye out on today right now is Biocon for the pharma space. Now, they've received a US FDA approval for the biosimilar, which is called bevacizumab. Now, this is an important one in terms of biosimilars because it's used for the treatment of a type of cancer. Do not forget, Biocon already has 2 more oncology portfolios in the US market. Now, this is the 3rd one coming in. So they are increasing and expanding their oncology portfolio. So market size of this biosimilar is around $2 billion, and this was as of 2023. There are already 4 players in this: Amgen, Amneal, as well as Pfizer, and 1 more company, which are already present in the US market. Now, what analysts are highlighting, they are estimating the drug to generate incremental sales of around $63 million in FY26 and $88 million in FY27. So a positive coming in for Biocon after this drug approval.
All right, we take that point, Vinny. Thank you so much for that. Meanwhile, a couple of other stocks which are spiking as well as we speak. We have Nippon Life India, which has moved to the high point of trade. It's up a 5% move that we're seeing. Lotus Labs is the other one which is spiking. CCL Products, that's the one which had seen a bit of a dip. That too has moved to the high point of trade, along with a couple of these fertilizer and chemical names. So we have FACT, which is up around 6.5%. Paradeep Phosphates is the other one, which is up 7%. And we are seeing some recovery in a couple of these quick service restaurant names. So we have Restaurant Brands Asia, the one that runs Burger King in India, is the one which is up close to around 4.5%. With that, I believe we're out of time on this edition of Chartbusters. Thank you so much for watching. From Nigel and me, the entire team. Take a short break, come back on the other side. You have the team of Trading Hour coming up next.